The economy may be about to do the impossible. Hey, everybody, you're watching Bull Boom Bear Bust. All right, Bulls and Bears, let's go ahead and get right into it here. Let's bring up a chart here of the Fed funds rate. And I want to ask you what you think is about to happen, because we're going to look at history and we're going to see what's very likely to repeat here. Now, some people are saying that there's going to be a soft landing and even no recession. While it's possible, it's very unlikely, and we're going to explain why here in just a few minutes. But first, let's take a look back at history with the Fed funds rate. And let me make myself a little bit smaller here if I can. And this goes all the way back to the mid 50s. And if you look at the dark shaded areas, those are recessions. And I should underpin that that's official recession, because many people would argue right now that we're in a recession when you look at the savings rate, right? But they don't want you looking at the savings rate, because then we would pretty much be in a recession for the past 2 years because the savings rate has plunged. What they want you to look at is spending, namely consumer spending, which stacks up to be GDP, gross domestic product. You also have to factor in government spending. So the whole, is there a recession or not, that question in itself is pretty much a scam, because they can pretty much print themselves or print the economy out of going into a recession. For example, look at 2020 when unemployment soared. Enough stimulus checks still allowed people to go out and spend money, and that kept the recession very small and brief. In fact, if you look at this chart right here, where my cursor is, you'll see just a tiny, tiny line. You can barely even see it. That's how short the recession was, because they printed so much money to basically bail out the economy. So could they do that again? And could they do it even sooner, so we don't ever actually have the negative GDP number, which would be looked at as a recession, two negative quarters, consecutive quarters. Anyways, let's go back here. 1950s, interest rate hike cycle and a drop in a recession. Interest rate late 50s, early 60s. Anyways, same thing. They started cutting, recession. Long time here, going all the way into the early 70s. They stopped raising them. They started cutting. We had a recession. More further into the 70s, mid 70s, rate hikes, cut, recession. You see the pattern here, folks. It's pretty easy to see. Rate hikes, and they started cutting, then a recession. Rate hikes plateaued for a few months here, early 2000s after the dot-com bust. They started cutting, and then recession. So it's usually typically after they start cutting, right? So if the words are true that we're hearing, that there's going to be rate cuts coming up here in 2024, then that's going to be the year of the, whatever you want to call it, economic downturn, recession. Some people even say Great Depression 2.0. So we look at this last hike period there, going into 2019 rather. We saw them started increasing these in 2016, and the rate cuts, and then a few months later we had the health crisis breakout. So that was kind of the cover for what happened. But same thing, rate hikes and then rate cut. Here we are today. We had big rate increases all the way from rock bottom. Now we've been paused for a while, and what's coming? Well, if they're if they are true to their word, we're going to see rate cuts. But what type of recession will we see, or will there not be a recession? If there's not going to be a recession, this could be one of the first times in history that that's ever happened. So does anyone think there's going to be this magical first time to have these rate increases followed by rate cuts and no recession, right? And again, the reason why the rates get hiked, of course, because usually inflation, the cost of living, and then the reason they have to cut is because all the debt comes due, and you start seeing so much damage, so much carnage in the economy. Now, going back again to 2020, that's a great example of how money creation and easy money could make this recession very short and brief. The problem is, if we don't have a recession or something to bring the cost of living down, to bring asset prices down, housing, everything else, then it's going to be even worse because then we're going to see more inflation on top of already high prices. And yes, they're telling us that inflation's coming down, that it's under control. Well, cost of living is still high. Just because the prices are going up more slowly, that doesn't help people. Prices going up slowly doesn't really help most of the people in the current situation. There's just too much debt out there in the economy. People need a correction, and yes, it'll be painful. There'll be a lot of job losses, and there'll be a lot of banks failing. A correction, a recession, an economic downturn. It's not pretty, but it's necessary to right the wrongs that we're seeing right now with this enormous cost of living bubble with housing and everything else. Speaking of that, let's talk about this inflation gauge that the central bank likes to point at. And this is the November number. And according to the source here, it tumbled. Friday's report from the Commerce Department showed the U.S. consumer prices slid 0.1% last month from October. So from October to November, um, they're saying it slid 0.1%. Here's the thing, it doesn't include food and energy prices. So why exclude that? Those are two things that people have to buy for the most part, right? Unless you're not traveling at all, you have to have some sort of energy cost. And then you have, of course, all the utilities that come with that. Food, I guess if you're talking about robots, people that don't consume food, but robots aren't people. So I'm trying to think of a way to justify these ridiculous numbers. Why exclude food and energy? Because they're saying they exclude them because they're volatile. Well, food's not so volatile. Food prices went up and they stayed up. So I wouldn't call that volatile at all. Energy, not really that volatile. Um, you know, so why exclude those? So pretty interesting that they're excluding things that most people use and consume. The so-called core inflation that includes those things actually rose 0.1% from October to November and is up 3.2% year over year. So every gauge that you look at, the official CPI, this one here out of the Commerce Department, the numbers are higher, and we're not at the 2% target. They tell us they have a target. So why are we talking about cutting rates, folks? Because something big, something huge is on the corner. The banks around the corner. The banks are on thin ice, and I think they're worse than on thin ice. I think they're below the ice. I think they're actually drowning right now, and the ice on top is frozen, and they can't get up to get a breath of air. That's how much I think the banks are drowning. But we'll see. We'll see what type of rescues and what type of helicopter money they're going to put into these banks this time. Problem is, again, it's going to be inflationary, keeping these banks operational. We need a big scare to make things right again, or to make prices become more affordable. That's what recessions and economic downturns are supposed to do. They're supposed to balance things out. When you have a massive bout of inflation, you then need a massive bout of deflation to correct that, or to get back to some normalcy. We've all seen those charts of the cost of rent and homes, and then you see it come down during a recession and usually reverts to the mean. Well, that's what we need. We need a reversion to the mean, meaning the bubble needs to bust. But the powers that be, they're looking like they're at least going to try to not allow the bubble to bust. This whole economic, what people are calling an economic boom, it was an illusion. It was artificial. It wasn't organic. Uh, and, we need a correction. But will the powers that be allow that to happen? We'll have to see. Again, I recommend everyone prepare for both. If we do see a massive crash, deflation, you want to have some cash. If we see inflation, you're going to wish you were invested in something. So have something that's going to go up with the cost of living. That's not going to be the be all end all solution, but at least you can, make some good things happen no matter what direction the economy goes into here. Let's talk about the stock market real quick. We've got the S&P 500 closed Friday. That was the longest weekly win streak since 2017. I did say here there was going to be a massive short squeeze. The S&P 500 rose Friday after cooler inflation data. Again, scam numbers. The NASDAQ was up. The Dow Jones actually fell a bit. But folks, what's going to stop the stock market? If all the things happening right now in the world, the wars, the cost of living, the consumer savings rate, ultra low, close to a 40-year low. If all these things are positive for the stock market, what's it going to take to bring this market down? Well, I think we're going to see something big jump out of the woods. Some things. There's going to be several things jumping out of the woods here in 2024 that I think a lot of you are going to be shocked to find out about. It has to do with the banks and a lot of the big money out there. A lot of the big people that the financial world looks up to are going to we're going to see that they've been you're going to see some surprises. Let me leave it at that. All right. Got to be friendly here. Got to be within the platform's guidelines, you know. People are so desperate for money that look at this. Bring this up here. Out of FX here, out of FB, Americans will pay $6.12 billion in penalty for early 401k withdrawals, right? The number of 401k participants accessing their retirement savings early increased 27%, according to Bank of America. So if everyone's doing fine, if the economy is doing fine, why are we seeing this record surge in people tapping their 401ks and collectively paying over $6 billion in penalties for taking out their 401k? There has to be some reason, unless people just decided to, go on a spending spree and pay all these fees to get their early retirement or to take money out of their 401k. There has to be a reason. The reason is people are having very, very tough time. And the longer we go, the harder and harder it's going to be for the economic engineers, the central planners, to cover this up, right? So we're going to find out very, very soon. We're not too far away. I try not to put timelines on things because so many different things can be done to manipulate this or to keep the game going longer than anyone expects. Expect helicopter money. Expect more rescues, more bailouts. It could be even more stimulus checks. We'll have to see. I wouldn't be surprised at all to see more stimulus checks come out. They'll of course have to blame it on something, some outside unforeseen thing happens, right? So we're going to find out what it's going to be very shortly. Everybody, Merry Christmas, Happy Holidays, seasons greetings, all the above. Thanks everybody for being here. You probably won't see me tomorrow because tomorrow's Christmas and I'm putting this out late on Christmas Eve, so you might even be watching this on Christmas. The day after Christmas, maybe. We've got some family things going on. Hope all of you are enjoying the holidays, enjoying your family. If you're not with family, I hope you're just enjoying yourself and being good to yourself, all right? So everybody, be well, stay well, stay healthy, and we'll talk to everybody very soon. Bulls and Bears, gonna wrap it up now. Bye now. Peace.